Buenas tardes a todos, bienvenidos a esta sesión que es una sesión en la cual estamos muy honrados de recibir un invitado especial y de trabajar de manera tan cercana con Rumania. Esta sesión se llevará a cabo en inglés, voy a cambiar de idioma ahora. So, welcome everyone, thank you very much Dr. Radulescu for being here, and thank you Ambassador for the organization and coordination of this series of meetings and events and dialogues with such a high-level guest from Romania. For the welcoming remarks, I will leave the floor to Guadalupe González, who is the head of the unit that is studying Romania, Black Sea, Cáucaso, and Oriental Mediterranean. Go ahead, Guadalupe.
Thank you very much. Good afternoon. We're very pleased as Council of Foreign Relations, the Mexican Council on Foreign Relations, a think tank dedicated to global and international affairs, to bring you here and to co-host this activity with the Romanian Embassy in Mexico City. This is not the first time we have done this. We have already built a long way in dialogues about Romania, the region, interregional relations. And for today, we have this excellent visit. We really thank that we were considered to have this dialogue on the economic questions, the banking question, the financing questions. For the Council and for Mexico, these issues are very important. As you know already, Mexico hosted the Finances for Development Summit some decades ago. We believe that the commitments in Monterrey by that time are still valid, but many crises have happened since that Finances for Development meeting. We are very interested in listening to you, hearing about the experiences of your bank, but of the development of new strategies to build regional development. We understand that we have a lot of connections in the region, and as well as with the European region and Central Asian region, the Mediterranean region, and we're happy that you decided to jump into Latin America and the Caribbean to keep these regions more open. Thank you very much, and I want to take more minutes to this very valuable activity.
Thank you, Guadalupe. So before leaving you the floor, I'd like to introduce Dr. Andrei Radulescu. He is a macroeconomist with post-university studies and professional experience in Portugal and Romania. After graduating from the Academy of Economics Studies in Bucharest in 2001, Mr. Radulescu successfully completed the Scientific Masters in Economics at the University of Porto in Portugal, a PhD in International Economics within the Academy of Economic Studies, and the postdoctoral degree in Economics at the Romanian Academy, the highest scientific forum in Romania. In terms of professional experience, Mr. Radulescu started his career in corporate finance at the Banco Português de Investimento at Porto headquarters. Afterwards, he did macroeconomic research and forecasting for the Portuguese Social Security Fund, the biggest investment fund in Portugal. In Romania, he worked for 7 years as a fundamental analyst and macroeconomist on the capital markets. Starting in 2014, he was appointed chief economist at Banco Transilvania, the largest lender in Romania, and a researcher at the Institute for World Economy within the Romania Academy. For more than 10 years, he has been a professor at postgraduate studies at the Academy of Economic Studies, the National School of Political and Administrative Studies, and University Baseball Yale. Andrei is a constant presence in international conferences on macrofinancial topics and in international and domestic mass media, including Bloomberg. Just to set the tone, Dr. Radulescu, I just want to mention how we started 2023 from a geopolitical point of view. We faced several events Some of them are a consequence of events that happened on 2022 or before. And just for that, I'll mention some. First, the invasion of Russia to Ukraine, which end is still uncertain, and its consequences on energy and food prices. We just seen the negotiation of the grain export deal from the Black Sea that was extended again, but for how long is still unclear, given different announcements made by Russia and the one made by Turkey and the UN as warrantors of the deal. An agreement for restoring relations between the Saudis and Iran was recently announced too, a deal that was mediated by China and not by the US. After decades of enmity and a formal cutting of ties in 2016, these rapprochement consequences in the region are to be seen. However, it will certainly reshape it. Already, Saudi Arabian government invited Iran's president to visit. The recent visit of President Xi to Russia as an affirmation of the alliance among China and that country, and a commitment for deepening the relations. Moreover, the visit reviewed the reshaping of global power dynamics with a clear alignment against the US. There were also statements toward the support of their economies and the bilateral energy trade that expanded in the last year as a consequence of the European Union's actions towards Russia. The state of the US-China relations seems that pressures over Taiwan and Hong Kong will continue from both sides. US will keep its efforts to limit China's technological advances in national security-sensitive areas. The possible attendance of President Xi to the APEC summit by the end of the year might be an incentive for trying to achieve a calmer moment within this relationship. Global warming and the recent publication of the UN Intergovernmental Panel on Climate Change that found that the world is likely to surpass its most ambitious climate target, which is limiting 1.5 degrees Celsius by the early 2030. And beyond that threshold, scientists have found climate disasters will become so extreme that people will not be able to adapt. Basic components of the Earth's system will be fundamentally or irrevocably altered. Heat waves, famines, and infectious diseases could claim millions of additional lives by centuries end, and it calls to urgent action today, particularly from developed countries. On the economic side, there seems to be consensus regarding the slowdown in global growth in 2023. Based on Fitch Global Macroeconomic Analysis, seems that we're moving to a period of multiplicity of smaller scale risks. The inflation risk is still there and is to be tackled. China reopening is a positive news in doing so, but still some other actions shall be taken. Moving to the Americas, we still need to assess the implications of the implementation of the US Inflation Reduction Act, as well as the scale of the attraction of investments, particularly in Mexico, due to nearshoring or friendshoring or allieshoring phenomena. Have we seen our first 2023 black swan with the US regional bank crisis? With all these considerations and this complex international context, I give you the floor to see where we're going in 2023, which risk we should be following, and which trends on the economic, on the global economy.
Thank you very much indeed, Guadalupe. Thank you very much indeed, Vanessa. Thank you very much indeed, everybody, for coming here to this event. I'm honored and responsible to deliver a good presentation for this very important, let's say, conference you organized this evening. And in this context, I thank the Ambassador of Romania in Mexico for co-organizing this event. Yes, indeed, what you mentioned in the previous minutes, it's very true. We started the year with the consequences of the overlapping supply side shocks, the exogenous shock that happened over the past years, namely the coronavirus pandemic and its consequences, and the crisis in Ukraine and its consequences. And beyond this, we also had recently, the beginning of March, actually in the first half of this month, the troubles in the banking sector in the United States and Europe. However, from my point of view, and I would like to emphasize the fact that the opinions I deliver this evening are strictly personal, so I'm not like them to be associated with the institutions I represent. It's a disclaimer that I have to emphasize before starting the presentation. From my point of view, it's not the end of the world. It's just the beginning of a new world. We are in the period of great transformations. And for those living during 2040, 2050s, so 20 years from now on, probably they will read books about the period of 2020s, read the books on the great transformations that are at present under development. First of all, what's happening nowadays, it's mainly, let's say, a consequence of the fact that we are in the total confrontation between US and China. These are the two largest economies of the world. If we look at the US economy, they generated the nominal GDP above $26 trillion in 2021, while in China, the nominal GDP stood at $18 trillion. So overall, these two economies represent more than 40% of the global GDP at present. And it's a total confrontation because, first of all, it's a technological one. And we are going to see in one of the charts that the share of the digital economy in the GDP of China is 4 times higher compared to the share of digital economy in US, for instance. We are talking about currency confrontation. We are talking about trade confrontation. And last year, the trade gap between US and China was very close to the record high level of 2018. We are going to see in one of the charts. And of course, in the middle of this big and total confrontation between US and China, we have from the economic and from the geopolitical and geographical point of view, we have Europe that seems to pay the invoice of this confrontation between US and China. And of course, if we look at what happened since the outbreak of the crisis in Ukraine, in Europe, we had a significant deterioration of the international competitiveness of the European economy, because the European economic model, since the reunification of Germany until the outbreak of the crisis in Ukraine, was based on basically on 2 pillars. The first one was the import of cheap oil and gas from Russia, and this pillar is not functioning anymore. And the second pillar was the exports of high value added goods to the Chinese market. And this second pillar is not functioning anymore because Chinese economy reoriented towards, let's say, production of goods and consumption of goods from China. And also we had that zero COVID strategy implemented by Beijing administration that had important consequences for the global trade. In this context, the US economy, the US reacted in order to keep as much as possible the hegemony of the past decade by implementing several, let's say, restrictions, several protectionist measures. And several people say that the US Inflation Reduction Act is actually a China Reduction Act. So they are trying to counter and to postpone as much as possible the transition of the hegemony from US to China. And this is positive for countries like Mexico, but it's not positive for countries in European Union that have no, European Union has no army, no? And, you know, the idea emphasized by President Sarkozy of France, I think a couple of years ago, when he said NATO is there and we have to build...
It's Macron.
It's Macron.
Yeah, it's right there.
Excuse me, yes. Excuse me. Macron said, I think, 2016, no?
No,
17.
no, it was last year or something like this.
So Europe has no army, basically. Europe has no political union. Europe has less resources compared to the United States, for instance. And in this context, of course, the European countries had to reorient, let's say, in terms of imports of oil and gas, basically from countries from the United States, if we talk about LNG, and from countries in Arab world. And in this context, if we look to what happened since the creation of the European Union, actually European countries managed to implement new governance after the outbreak of each crisis that determined, let's say, the consolidation of the EU process. My background is in European integration, so I'm quite confident that the European leaders will find solutions in order to deliver a better governance at the European Union level, mainly on the euro area level, because euro area represents the core of the European Union. Regarding the inflation, it was the biggest surprise of last year, but already if we look at the recent data, we had the change of the trend in terms of the year-on-year dynamics of the consumer prices. And this change of the trend from an upward one to a downward one has been determined by several factors. First of all, everywhere we have dynamics of the economy below its potential. So we are in a period of negative output gap. On the other hand, we had a significant increase of the nominal interest rates, monetary policy interest rates, and this is already having an impact in terms of the demand. Either we talk about the US economy or we talk about the European euro area economy. And of course, we had adjustments in terms of the international prices for food goods and also for energy. This adjustment started at the end of last year. So the inflationary pressures are already, let's say, fading out gradually. And probably by the end of next year, the year-on-year dynamics of the consumer prices would be very close to the target of the central banks in the developed countries. Either we talk about the US or we talk about the European Union countries. Regarding the geopolitical tensions and the fact that we are in the transition towards a new world order, I cannot tell you so many things because from my point of view, the new world order is dependent on the negotiations between US and China. So we are not going to see a stop of the geopolitical tensions. We are not going to see, let's say, positive issues on the global arena unless the representatives of the largest economies of the world sit on a table and start to negotiate, as happened, let's say, in 1944 at the Bretton Woods between US and the UK representatives. So when the negotiations between US and China are going to start, I cannot tell you. I'm not a fortune teller. But from my point of view and from the economy point of view, China has no hurry to start the negotiations because China has the resources and China has, let's say, an approach of basically a Confucianist approach, and this is more related to the soft power, not hard power, like happened in the United States since the end of the Second World War. If I can start a couple of slides that I prepared for you today in order to have an image of what I already said regarding the global economy. I will just pass, let's move a little bit forward. Before starting, I think I selected two mottos. One belongs to the former Prime Minister of UK, Mr. Winston Churchill. And I put this motto because I'm a European citizen, and he always emphasized the idea of the world that we have to build the United States of European Europe. Unfortunately, the politicians added on this United States of Europe, but we cannot talk about United States of Europe because Europe has no army, Europe has no political union, and in this context, the Eurozone is not an optimal currency area. And on the other hand, I selected the word risk, which is written in Mandarin in the form of two characters. The first one represents the danger, and the second one, the opportunity. So Vanessa talked about many risks, overlapping risks, economic, geopolitical, social. But if we look at the, let's say, Chinese approach, to each risk factor, we have at least one opportunity. So I invite you to see the risks, to understand the risks, but to try to identify the opportunities that these risks are bringing, because at least from the corporate level, so the company's level, the best opportunities are during the times of changes, not during normal.
When there is blood.
Yes, yes, not during normal times. So let's move forward to see the chart, please. So this is the era of great transformation, but I emphasize again, just personal opinions, not okay. So global economy is already in adjustment phase following the overlapping supply side shocks and the geopolitical tensions. We are in the middle of great transformations, and these are basically transition towards new models of growth and development in the context dominated by digital revolution, climate change, because Vanessa talked about climate change, not only she emphasized a lot the role of and the attention that we have to pay to climate change and the total confrontation between the largest economic blocs. In fact, we are in the middle of the transition from the globalization of efficiency that happened over the past 4 decades, since the Reaganomics started in 1980s United States, to the globalization of resilience. Or I've heard and I read a lot about Mexican economy, so you prefer to say nearshoring instead of globalization of resilience. And this transition is basically done by the fragmentation of the economic flows that happened after the outbreak of the crisis in Ukraine. And you talked about the agreements in terms of exports of grains from Ukraine to Europe and to the rest of the world, because Ukraine has been an important, let's say, player on the global grain market. So actually what happened starting 24th of February last year, we had the fragmentation of the economic flows between Euro-Atlantic bloc, and Romania represents the eastern border of this Euro-Atlantic bloc, and the Eurasian bloc, which is basically represented by China, Russia, India, Iran, other Arab countries, and other emerging countries, including probably Brazil, because Brazil is part of BRICS, no? So this fragmentation, it's not only from the economic, not only from the real side of the economy, but also from the financial side of the economy. As Vanessa said, as last year we had a visit paid by President of China to Saudi Arabia, no, and they signed an agreement that Saudi Arabia would trade away on Shanghai Stock Exchange, no, in yuan. And this announcement had already impact on the FX markets, because before starting that agreement, we had a depreciation of the dollar against the euro. And this can be noticed by the charts. Basically, we have a total economic confrontation, technological, economic, and military between US and China. And this confrontation is going to continue in the coming years, unless they sit on the table and start to negotiate a new world order. If we look at the US economy, the largest of the world, it's in a de facto recession, as we are going to see in the coming slides. In China, the reopening, and also Vanessa mentioned the fact that the reopening of China would have a positive impact for the global economy. And overall, the Euroland is paying the invoice of what's happening in Ukraine, and the Euroland economy is going to underperform in 2023 and 2024. Let's move forward to global trade. We have this very interesting and very important chart from my point of view: global trade and global industrial production. And you can see that the global trade, which is, let's say, a very important benchmark of globalization, and the international trade is also a leading indicator for the global industrial production. As you can see, anytime we had an acceleration of the international trade, this is followed by the acceleration of the industrial production. Anytime we have a contraction or a downward trend for the international trade, we have a negative impact for the global industrial production. What we can see from this chart is that the global trade started to contract again at the end of last year. So basically, the data published by Bloomberg show that in December last year, we had a contraction of the international trade by around 3% year on year. It's the toughest or the most severe pace of decrease of the international trade, of the global trade, since August 2020, so since the first wave of the coronavirus pandemic. And this is already having a negative impact for the global industry. So we can say that the global economy started not in a very good shape the year 2023. Let's move forward. And this not very good mood, in order to try to maintain the positive approach, no, it's also supported by the fact that the global uncertainty index continues to present a very high level, as you can see on this chart. So we continue to have, let's say, very high level of uncertainty, and this high level of uncertainty, it's having a negative impact for the investments of the companies, because the companies, when the uncertainty persists, they are trying to prioritize the investments, and overall the volume of investments is lower compared to normal times. Let's move forward. This is macroeconomic developments. Because I said that all the economies started the year not in a very good shape, you can see here that we had 6 consecutive months of contraction for the global economy. If we look at the PMI indicators computed by Market Economics and published on a monthly basis. However, in the month of February, we had a rebound of the global economy. So PMI indicators presented levels above the 50 points threshold. But overall, if we compute the average for both indicators, we are going to see that at present these indicators present values below the midterm average. So in this context, we can say that the global economy presents its, let's say, confronted at present with a negative output gap or with a dynamics below its potential. Okay, so we can see the downward trend for both manufacturing and services, despite the fact that in February the global economy presented, let's say, a rebound compared to what happened over the previous months. But overall, these indicators continue to have levels below the trend. So we can say that the world economy, let's say, it's continued with dynamics below its potential. Okay, let's move forward. US economy is in a de facto recession. In US, the largest economy of the world, it's an institution, a body, National Bureau of Economic Research, that establishes when the US economy enters a recession and when the US economy exits a recession. Probably they are going to acknowledge the recession in the US throughout 2023. Several indicators point out the fact that the US economy is in recession. First of all, we have this spread between the 10-year yield and 3-month yield for the US bonds market. And you can see that anytime this spread between long-term maturity yield and short-term maturity yield presenting negative values, it signals the, let's say, the prospect of recession in US. And we have data since 1980. So you can see in, for instance, 1989, negative value for this spread already signaled the recession of the end of the 80s for the US economy. We had negative values at the beginning of 2000s when we had the dot-com crisis, another recession for US. We had the negative values before the outbreak of the great financial crisis, you can see in 2007. We had negative values before the outbreak of the coronavirus pandemic. And recently we have very, let's say, record low levels in terms of this spread. So if we look at, for instance, data published by the Bureau of Economic Analysis, last year, the fixed investments in US contracted by 0.2% year on year. So we had an increase of the economy by 2.1%, but in a context of contraction of the fixed investment. So de facto, US economy is in a recession. Let's move forward to the following slide. And this scenario is also supported by the fact that you can see very easily from this chart, labor productivity contracted for four quarters in a row in US. And overall, in 2022, the labor productivity in US declined by the most severe pace since 1974, when the US economy was confronted with the first oil shock, global oil shock. So it's another signal, it's another strong, let's say, chart supporting the scenario of recession in the United States. Moving forward, please. We have this trade gap between US and China. And you can see that last year overall the level was around $366 billion. The trade gap between US and China is the second highest on a historical basis. Actually, what we can see is the fact that the policy implemented by China's zero COVID strategy determined, let's say, a significant deterioration of the balance of trade between US and China. And in this context, the US economy, US politicians, US policymakers reacted by implementing the US Inflation Act, but which is not US Inflation Reduction Act, it's actually China Reduction Act. Moving forward. Total confrontation between US and China. First of all, we have technological confrontation. You can see here that at the global level, the dynamics of sales of semiconductors has been on a downward trend over the past quarters, and China continues to produce more compared to sell more compared to the United States. We are going to see the following chart showing. Let's move back, because that chart I talked about is at the end of the presentation regarding the share of the digital economy in the GDP. But what we can see from this chart is another sign that the global economy is at present underperforming, because we have a significant deterioration of the sales of semiconductor, and these semiconductors are very, let's say, used, for instance, in automotive industry, and automotive industry is a strong indicator for the real economy. So when people increase the demand for cars. This is a positive signal for the global economy. When people diminish their demand for cars, this is a negative signal for the economy. And the fact that we had a downward trend for the semiconductor sales at the global level, this means that the global economy is underperforming, or confirms the fact that it's, let's say, presenting a dynamics below its potential. Moving forward to Europe, you can see here that we had a rebound of the investors' confidence in Europe. Actually, in the month of February, the investors' confidence indicator completed by two institutes from Germany returned to the level of February 2022, and we had the outbreak of the crisis in Ukraine. But overall, if you look on both lines with outlook and current situation, we can see that since the outbreak of the crisis in Ukraine, we had a significant deterioration of investors' confidence. Actually, investors' confidence in Europe started to improve at the end of last year because, first of all, we had this capacity of European countries to reorient to imports of oil and gas from other countries instead of Russia, because European economy was hugely, let's say, dependent on imports of oil and gas from Russia. And on the other hand, we started to have adjustments in terms of prices of food and energy starting in November last year. And these factors determine an improvement of the investors' confidence. However, recently, so this week, the two institutes published the data for March, showing a deterioration of the investors' confidence in the Eurozone, and at present the investors' confidence in the Eurozone is at the lowest level since December last year. So overall, we continue to have low levels of investors' confidence, at least compared to what happened during the post-crisis cycle and during the period, let's say 2021, 2022, before the outbreak of the crisis in Ukraine. So overall, the confidence rebounding in Euroland, but continues to present low levels from the historical perspective. Moving forward, we can see the deterioration of the international competitiveness in the Eurozone, and this was very, let's say, pronounced last year. You can see a strong dynamics of the imports, the value of the imports of goods because of the increase of the international prices of food and energy. On the other hand, we have quite a flat dynamics of the exports, due to the deterioration of the global on the global economy. So this is very important for Europe because Europe, as you can see very easily from this chart, used to have a positive trade balance over the past 3 decades. So this is another risk for the dynamics of the Eurozone economy, for the European economy in the short run, unless they start to implement measures in order to restore or to improve the international competitiveness. Moving forward, the macroeconomic outlook. You can see the forecast for US economy, China, and Euro area. The better forecasts are for the Chinese economy because they reopened the economy, and already the figures for China for the start of the year, this year, are very good because people started to resume the consumption as during normal times. And on the other hand, we have, let's say, unfavorable forecast for the Euro area economy and for the US economy. So overall, you can see that in 2023, 2024, and 2025, these economies are going to increase by or to present year-on-year dynamics of GDP very low dynamics of the GDP, year-on-year dynamics of GDP in the short and mid run. In this context, Chinese economy is going to narrow the gap to US in terms of nominal GDP. And probably by the end of this decade, it's a paper I presented in Barcelona last year, nominal GDP of China would outpace the GDP of the United States. So the largest economy of the world will not be anymore US, but will be China. Moving forward, so overall subdued economic growth, and inflation is forecasted to slow down significantly. Why? Because inflation has been mainly, the inflationary spike over the past quarters has been mainly determined by the overlapping supply side shocks and by the fact that in both Europe and the United States, the policymakers implemented important measures in order to support the households after the outbreak of the coronavirus pandemic. So people saved a lot during the months and quarters of pandemic. And last year, given the reopening, they consumed a lot in order, let's say, to revenge almost 2 years of subdued consumption in both Europe and United States. But overall, the forecasts are for inflation to significantly slow down and to converge to the targets of the central banks. And this scenario is supported by the fading out of the impact of the supply side shocks, by the normalization of the monetary policy, and by the recent adjustments in terms of prices of energy and food on the global level. Moving forward, we have this chart showing the dynamics between money velocity and core inflation in the United States. And this is another chart supporting the idea that inflation is going to slow down, because this time, compared to history, you can see that we have an acceleration of the inflationary pressures, but this has not been determined by the increase of the money velocity. So you can see in the past, from 1960 until 2023, that anytime we had an inflationary spike, this was short-lived because it was not accompanied by the increase of the money velocity. So we can talk about persistent high level of inflation if we have an increase of the money velocity. But this didn't happen over the past years. Actually, what we can see from this chart very easy is the fact that since 1995, the money velocity in US presented a downward trend, okay? And despite the fact that in US, the Federal Reserve implemented those quantitative easing programs, so the amount of money available on the market was increasing with huge paces following the outbreak of the great financial crisis and also following the outbreak of the coronavirus pandemic. The quantity of money increased significantly, but that didn't determine an increase of the money velocity. So actually what happened, the QE policies implemented by the Federal Reserve had more impact in terms of the dynamics of the pricing of financial assets and real estate assets, and a lower impact in terms of the real side of the economy. So inflationary pressures are going to slow down because money velocity didn't increase, okay? Moving forward, the real financing costs maintain affordable. As you can see here, we have a very high level of inflation and a very low level of yield on 10-year bonds. Yield on 10-year bonds is, let's say, a benchmark for the financing cost in the economy. For the following years, we are going to see a slowing down of inflation and a gradual decline of the yield on 10-year bonds. So it's not the end of the world, it's just the beginning of another world. And if we read the papers published by the IMF immediately following the pandemic, they emphasize the fact, based on historical analysis, that anytime we had a severe pandemic in the past centuries, we had a long period with low levels of the real financing cost. So I expect, again, the central banks to recalibrate the monetary policies and inflation slowing down, and central banks to start cutting the policy rates by the end of this year. Moving forward, we have, unfortunately, limited maneuver room in terms of fiscal policy, because you can see here the level of the budget deficit GDP ratio for both advanced economies, advanced countries, and emerging and developing countries. And we can see the fact that these deficits continue to present high levels, and in this context, we have a limited maneuver room in terms of fiscal policy. Why? Because these levels increased significantly during the pandemic. No, all governments across the world implemented unprecedented measures in order to counter the impact of the pandemic on the economy in both advanced economies and emerging and developing countries. Moving forward, as you can see from this chart, we have a very high level of public debt to GDP ratio, especially in advanced economies. You know the problems in the United States with the debt limit. Now we are going to see how this is going to be addressed by the US policy makers. And of course, it's very tough, the fact, and it's very bad, the fact that across the emerging and developing countries, we had a significant upward trend for the public debt GDP ratio. Actually, public debt GDP ratio increased by more than 20 percentage points in the emerging and developing countries over the past 10 years. So this is not a good thing for the emerging and developing countries. Moving forward, challenges and opportunities for the coming years and throughout this decade. First of all, we are going to see an increasing role of the emerging and developing countries in the global economy. As you can see here, the share of the GDP of the developed countries as a percentage of the global GDP, it's on a downward trend. And probably 2025, 2026, we are going to see the share of the GDP of emerging and developing countries outpacing the share of the GDP of developed countries on the global level. So actually, the greatest part of the global GDP would be generated by emerging and developing countries starting 2025, 2026. So we have a change of the power, change of the weight in terms of contribution to the global GDP from advanced economies to emerging and developing countries. Moving forward, a bumpy road of globalization. You can see that since 1997 until now, the share of the exports in the global GDP cannot outpace the threshold of 30%. So it seems to be, how to say,
Threshold.
yes, it seems that God put there a ceiling 30%, and we cannot move above 30%. So the globalization is also bumpy. You can see it's not on upward trend. We had the great financial crisis, a significant decline of the share of total exports in the global GDP in 2009, you can see. And also we have the coronavirus pandemic with another fall of the share of the global exports in the global GDP. Moving forward, openness degree seems capped, because openness degree is the sum of the exports plus imports over GDP. So we have the cap at 60% for the sum of the exports and imports over global GDP. Moving forward, developing countries continue to converge towards the advanced economies level, but you can see that it continues to be a huge gap in terms of GDP per capita of emerging and developing countries, EDC, as the share of the advanced economies. At the level of 2022, it's still below 25%. So the level of GDP per capita overall, the average in the emerging and developing countries, it's less than 25% the level of GDP per capita in advanced economies. But this means that the emerging countries have huge potential to converge to the level of the advanced economies. Moving forward, strong investments. You can see that emerging and developing countries have invested much more as a share of the GDP over the past 20 years, since 2000, at least compared to what happened in advanced economies. And of course, this upward trend of the investments share of GDP of the emerging and developing countries also contributed to the increase of the public debt GDP ratio in emerging and developing countries. Moving forward, China is leading in terms of digital revolution times. We can see here the value added of the digital economy of the share of GDP in China and the United States. And we can see that it's a huge gap. It's more than 4 times the level of digital economy as a share of the GDP in China compared to what's happening in the United States. So actually, China is going to turn the largest economy of the world in the coming years, and probably this would force the United States to start the negotiation for the new world order. Moving forward, I think I have another slide. GDP per capita in Germany, you can see the gap between US and Germany in terms of GDP per capita purchasing power parity expressed in dollars, data from International Monetary Fund. Starting in 1999, when we had the launch of the euro, we can see an increase of the gap between US and Germany. And this is very representative chart showing that the way the monetary integration in Europe was, let's say, implemented was not an optimal one. So actually, in terms of development, Eurozone is diverging from the United States. And this is bad for Europe, but bad for countries that are dependent on what's happening in the Eurozone, including Romania, because our economy is very much dependent on economic flows with Eurozone. Moving forward, in Eurozone, we have this main challenge, namely the fact that the total factor productivity had a negative contribution to the year-on-year dynamics of the potential GDP. So this is the main problem in Eurozone, the fact that we cannot have, let's say, an improvement on a sustainable basis of the contribution of the multi-factor productivity to the year-on-year base of the potential GDP. And that's why we had, let's say, an increase of the gap, widening of the gap between US and Eurozone in terms of the GDP per capita. This is the main reason. And moving forward, further adjustments are forecasted for the financial markets. This is a technical indicator. It's a gap between VIX. VIX represents, let's say, the volatility for the S&P 500 in US, and PER is price earnings ratio. And this technical indicator, this very abstract indicator, is pointing out the fact that probably the stock markets would continue to adjust in the very short run, but for the end of this year and for 2024, probably we are going to see a significant upward trend for the stock markets, because already all the bad news have been incorporated, unless a third world war starts, and we are going unless this is going to happen. I'm quite optimistic that the global economy will move forward. We are going to see big transformations and big investments in US, Europe, and China. And of course, probably these emerging countries are going to benefit more compared to advanced economies. And moving forward immediately. So stock market would rebound after the short-term adjustment. As you can see here, this is the best indicator from my point of view. The share of the market capitalization in GDP in the United States. We had a significant adjustment last year. Last year, S&P 500 from United States adjusted by more than 19%. So after bad times, we are going to see a rebound, and probably this market cap GDP ratio would converge to the 5-year average in 2024. The average over the past 5 years is over 220% of GDP. And last chart, I think, no? Yes, a new financial architecture is needed. As you can see, the share of China in the global GDP is moving up, but the share of the yuan in the international reserves continues to be very low. So actually, in terms of global financial architecture, this continues to be dependent on US dollar. I think this is the end now. Ample excess liquidity. I already talked about the QE programs implemented by the central banks across the world following the outbreak of the great financial crisis, and especially following the outbreak of the coronavirus pandemic. We are not going to return to the pre-pandemic levels. Mm-hmm. So this creation of money is going to, let's say, to fluctuate between all kinds of assets, like plastere circulante. In physics, you have
the volume will remain constant.
Yes, but we're going to see ample movements between the asset classes.
Okay.
In physics, it's a name communicating recipients.
Okay.
Okay, and this, I think, is the end. Conclusions. It's not the end of the world, please. It's just the beginning of a new world. All depends on US-China negotiations. From the investment perspective, more than ever, the focus is nowadays on quality. Big infrastructure programs have been announced in US and China, and also in Europe. We have the Next Generation EU program under implementation. The climate change and the acceleration of the implementation of ECG are going to dominate throughout the rest of this decade. Is needed the reform of the international institutions and the international monetary and financial architecture. And of course, largest economies of the world, US, China, and Europe, would be more focused on the opportunities offered by Africa, because Africa is the last continent that joined the globalization process. Thank you very much indeed, and I'm very open for questions.
Thank you very much, Dr. Radulescu. At this point, we open the floor to questions. I don't know if we have someone yet. And here go ahead.
Please.
If you can say your name and make the question.
Okay. Thank you so much. My name is Mariel Peña. I have 2 questions, but I would like to ask it for both of you, if possible. The first one is, how would you describe the historic relation between the banks and the government? Does the government has had a positive influence into Romania development?
You repeat, please.
Okay. The government has the means to influence the development of Romania.
Yeah,
of course. We manage the development of Romania.
How would you describe the relation between banks and government?
It's a good one. Romanian government didn't have to intervene after the outbreak of the great financial crisis in order to bail out any bank in Romania. and the banking sector at present in Romania is very sound. We have very strong indicators in terms of capital adequacy ratio, in terms of NPL ratio, in terms of return on assets, return on equity. So the main, let's say, problem is the fact that the banking sector has a big exposure on the government bonds. Overall, it's above 20%, it's one of the largest in European Union. But I do not see, let's say, dramatic risks from this exposure of the banking sector to the government bonds, because the level of the public debt GDP in Romania is below 50%. And the country is doing well. I have a presentation on Romania. We were the champion in terms of EU convergence process, in terms of nominal GDP per capita at a level of, as a percentage of the EU average. We started from below 40% when Romania signed the EU treaty agreement in 2005. Now we are around 74% of the EU average. So we managed to almost double the GDP per capita in purchasing power parity as a percentage of the EU level from 2005 when the treaty was signed until 2021, the latest figures available. The government implemented several measures since the outbreak of the coronavirus pandemic that were very efficient, despite the fact that the maneuver room in terms of fiscal policy was very low, because Romania is the only one country member of the European Union under excessive deficit procedure. And with very low resources, very low maneuver room, they managed to, to generate a positive impact for the investments. The most important program was SME Invest program. So it was a special program for the small and medium sized companies in Romania. And in this context, Romania was one of the few countries across the world that in the 2020 pandemic year, with unprecedented high level of uncertainty, Romania managed to have a positive year-on-year dynamics of the gross fixed capital formation. At present, the government is pro-business. Last year, we had an increase of the gross fixed capital formation by 9.2% year-on-year. So a strong dynamics of the fixed investments. We had record inflows of capital. We had record inflows of foreign direct investments around 10 billion euros, record level of remittances, and record level of EU funds absorption for 1 year. So.
We have a question from the Zoom from Viridiana Lara. How the 2023 US recession affects the rest of the world?
Yes, as I presented several slides, de facto, US is already in, let's say, negative output gap with a high probability of recession. But take into account, let's say, the fragmentation in terms of global economic flows, from my point of view, at least, we cannot apply anymore the principle that used to be applied over the past decades, that when America it's, let's say, the rest of the world catches pneumonia and no. So this principle, from my point of view, cannot be applied because already Europe, and you can see how fast European countries reoriented in terms of imports of oil and gas. In a couple of months, they managed to avoid, let's say, a strong energy or a severe energy crisis. Of course, also the mild temperature during the winter helped a lot the European countries, but overall nowadays, from the let's say production function point of view, the difference between countries is mainly determined by the multi-factor productivity, because all the countries have access to capital. It's a total competition on the global arena in terms of human capital. So the countries that pay more, they manage to catch and to attract the human capital. And the difference is done by the multi-factor productivity among the countries. So yes, US is in a big trouble, but this doesn't mean that what happened during the past decades when US is in recession, the global economy is in recession, does apply, because China, or China's role in the global economy, it's getting, let's say, from one year to the other higher, and China has available resources, and they also have the capacity to involve several emerging countries in theirs, or in their, try to get these countries close to their flows. So yes, US economy is going to present negative output gap, but this doesn't mean that all the countries across the world would be in a bad shape due to the US recession. Actually, it's a time of opportunity for emerging economies. This is my view for the Mtra or across the global economy. And I think both Romania and Mexico have very good opportunities to grasp and to try to transform into reality.
Doctor, thank you very much. We know you have to run and get a flight.
Yes.
We have some other questions. If that's okay with you, we'll send them to you.
Yes.
And we can.
No, one more time.
If not, they're flight. But thank you very much.
The pleasure.
Thank you very much. We will send you the questions
And
and we'll keep in touch. Sure.
thank you.
Hope to see you
Thank you very much.
more often here in Mexico.
Thank you.
Bye.